Joining me now is John Stoltzfus, Chief Investment Strategist at Oppenheimer. John, a lot of moving parts today. Nuclear subs moving, social media in the picture as usual. But how big a deal is this jobs number, the revisions, and the implications for rates and policy for the rest of the year?
Well, great to be on CNBC with you, John. It's been a while since you and I have been on together on CNBC, and I always enjoy speaking with you, so how fortunate to be here today. First off, related to the numbers that came out today, we do know that the jobs numbers were exceeding expectations over the last few months, and now we had revisions over the last over 2 months, the prior months. In addition, a big shortfall here, the jobs number. But these numbers tend to be volatile, and we have seen them time and time again. As you know, I've been in this business since 1983, so I've been through every boom, bust, and recovery cycle since that time. It doesn't make me infallible, but that said, some of this stuff looks very familiar. Generally speaking, the market will take a haircut on that without a doubt, and likely also any increase in potential hostilities related to geopolitical risk, another little bit of a haircut in there. But what we're looking at is revenue and earnings growth. The overall trend within the tariff picture and its drama is to draw attention to the need of a more even or fairer plane when it comes to global trade for the United States and workers and businesses in the U.S. The problem is tariffs are never an easy thing to digest. Comparison to Smoot-Hawley is a little bit dated in the sense that that's over just about 100 years ago, isn't it? And it was a very different world. This is the digitalized world. Things move quicker, information moves quicker, and negotiations can happen when you least expect it.
Well, John,
just look at last week.
Yeah. Well, what about this idea, though, and our Steve Leisman was just bringing this up, that the hard data is now starting to reflect the negativity that we saw earlier in the soft data, where consumers haven't been feeling so great, and also hearing from Whirlpool in recent days that some of the shipping ahead of tariffs into the economy from some of their Asian rivals has actually affected their business, to me reinforced the idea that we haven't yet started to feel the real economic effects of some of this policy. Maybe we will. How is that reflected in your 7,100 year in price target?
Oh, I think most certainly is reflected in it, and in our thoughts, what we're considering here is to paint the S&P 500 with a broad paintbrush we believe is the wrong thing, because many companies have already diversified their supply chains over the course of the last few years, particularly after COVID-19. To more friendly nations, that have gotten better tariff deals. There's also all kinds of workarounds and carve-outs that happen. We do have, at current time, we've got the Federal Reserve, after today's numbers, has more reason to be able to comfortably cut in September. And we think they'll do an anniversary cut, a down payment for Wall Street, Main Street, to show that indeed the hike cycle is in the process of unwinding. They think anywhere from 25 to 50 bips in September, with likely another quarter sometime in November or December. So when we look at it, we've got to figure, what is the market like? It likes revenue growth and it likes earnings growth. We do believe that the soft data that was evident early on and that showed up in sentiment had actually reverted to more positive in terms of sentiment readings by the University of Michigan, as I recall. I think even earlier today it looked a little bit than was expected. But these are always likely to be go back and forth because they're surveys, and surveys are emotion. Remember, the markets are a combination of math and emotion. And so as a result of that, cooler heads, we think, prevail here. So we think we're in better stead than we were a year ago.